The Alt Goes Mainstream podcast is brought to you by Juniper Square. What if managing private equity, venture, and real estate funds could be seamless and scalable? Meet Juniper Square, the fund operations partner to over 2,000 private market GPs worldwide. Juniper Square gives GPs the connected software, data, and fund administration services needed for modern private markets. No matter how ambitious your next raise is, how many investors you manage, and how complex your investment vehicles are, Juniper Square empowers GPs to raise capital faster, reduce operational risk, and deliver a world-class investor experience. And with Junie AI, Juniper Square's enterprise-grade AI built for private markets, GPs can truly and finally unlock the power of AI to work smarter, move faster, and focus on relationships and returns. Scale your business, not your operational burdens and costs. Visit junipersquare.com/AGM today to learn more.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's podcast is with an elite performer on and off the field who has gone from protecting quarterbacks to protecting families' wealth. We sit down with former NFL and USC star Winston Justice, whose entrepreneurial spirit that was stoked while he was still playing in the NFL had led to a career in wealth management. He was recently named CEO at SageSpring Private Wealth, a $7 billion independent wealth management firm, as they look to grow organically and inorganically and expand their offerings in private markets for their clients. A former NFL offensive lineman, Winston played for the Philadelphia Eagles, Indianapolis Colts, and Denver Broncos from 2006 to 2015. He also co-founded an early-stage investment vehicle, MJC Capital, and Elixr, a gourmet café and coffee roastery, all while he was playing. He also won 2010 Walter Payton Philadelphia Man of the Year award for his community service. He then transitioned into financial services and wealth management post-career, starting at Wells Fargo Securities, where he specialized in institutional and family office advisory. He was then a portfolio manager at PIA's Alternative Investment Group, and then an investment manager at AllianceBernstein. Winston and I had a fascinating discussion about the parallels between sports and finance, what stoked his entrepreneurial spirit, why wealth management is so critical to people's lives, why culture fit is so important when integrating advisors into wealth management platforms through acquisition, and how private markets can add to an advisor's practice. Thanks, Winston, for coming on the show to share your story, wisdom, and experiences.
We're going mainstream.
Winston, welcome to the Alt Goes Mainstream podcast.
Thank you so much for having me.
Pleasure to have you. I think we're going to have such an interesting conversation. You had a fascinating two very successful careers. So I'd love to hear your background and really tie those things together. So how did you end up in wealth management?
I grew up in Long Beach, California, and my parents are from Barbados, and sports wasn't really pushed that much, but I started playing sports as a means to get myself out of Long Beach. Even though Long Beach is really nice now. I started playing sports. I ended up getting a scholarship to USC, and when I was at USC, I majored in public policy, which is a major to stay eligible to play football. Right? So it wasn't finance. And it wasn't until I was with the Eagles that I really wanted to get into business, and I wanted to do something that was revolving around finance or investing. And so when I was with the Eagles, I started a small VC fund with some other athletes, and that experience made me realize that I didn't want to be on that side of the market, of that side of investing, and also started a small chain of coffee shops, which are still in existence today. But from that experience, it made me realize I wanted to be on the public side of the market. And when I was playing, when you're done playing, it's not like you just stop and there's a press conference and you're like done. It's like you think you could play, but like no one else thinks so. So I got to that point where I thought I could play. No one else thought I could play, but I prepared up to that point. Right? When I was at the Eagles, I went back and got a master's in finance. I started the VC fund. I had my own business. So I was prepared for it, but it's just hard to make that transition. but I did. And I started at Wells Fargo as an analyst. And then from there, I went to be a portfolio manager of a fund based in Santa Monica. And then from there, I went to work at Bernstein. And Bernstein, that's where I really immersed myself in the wealth management. I manage assets for small to mid-sized institutions and then also family offices. So that's how I got into it. I know that's a roundabout, question. I mean, there's probably so many levels there we could get down into, but that's how I got to be into wealth management.
I love that journey. It feels like it was very natural. Like you kind of just took every step that just felt right to end up in the space that you're in and explored other things too. I mean, I'd love to talk about how the fact that you built a business that's still running the coffee chains that you have, how that helps you working with entrepreneurs or being a wealth manager for people who've built successful businesses themselves. But first, I think there's another interesting theme and trend in there that we're starting to see happen today is more players in sports. They think about life after sports while they're playing. What made you say, I want to start thinking about and preparing for my next career while you were still playing?
Well, and to your point, yeah, I think players are getting a lot more sophisticated. They're thinking about life after football. They're using football or any sport that they play. It could be basketball, tennis, soccer, as a platform to do something even greater. Athletes now want to have more successful careers after they're playing and during, because quite frankly, you're going to be a retired athlete a lot longer, hopefully. The reason why I started thinking about a career after football is basically out of fear. I didn't want to go back to where I was from. And so I was like, hey, I need to figure something out because I don't want this to be the best time of my life. It was more than that because I was also searching for significance and purpose. And I thought the wealth management industry, also the investing industry, was extremely significant and extremely had a vast amount of purpose, especially for the families that you work with and also for the institutions you work with, but mostly for the families. You're dealing with something that is extremely sacred. It's someone's life savings. No matter how rich you are, $100 million, $10,000, if it's your life savings, it's like your life savings. And I want to emphasize life there. And that's really important, right? It's like your lifeblood, it's your assets, and that's a very sacred place to be. And so when I wanted to do something after I was playing, I wanted to do something that was very significant for myself, but then also for the families and the clients I worked for or served.
I think that really gets into the nuts and bolts of wealth management. When you think about what it is, it's really about helping people plan their future, plan across generations, and plan and save for retirement. I think there's a ton of things there that get into the different ways in which people can invest. I think that's why we're seeing private markets become a bigger part of the options of investments, retirement solutions. Apollo has branded themselves to some extent as a provider of retirement solutions. And I think that's so important when it comes to thinking about people's financial lives. So I'd love to dig into that aspect of things in terms of when you were thinking about getting into the wealth management space and starting early on. What did you see and what did you learn early on that's helped you now today as you run SageSpring and try to build and grow the SageSpring platform?
Finances are really sacred, and people will talk about anything, addictions, problems, but when it comes to finances, people are extremely guarded. So being in those living rooms is a very sacred place to be. That family or that institution has to give you or entrust you with a lot of trust. And that's a very special place to be. So I realized that really, really early on, working with families to be in those rooms is great. And I know you mentioned something earlier about retirement. Something a lot of families are looking to do now is a transfer of values and knowledge and wealth too. But it's mostly, hey, how do I transfer my values and my knowledge to the next generation in the most efficient way possible? And there's no one answer to that, but you need to be intentional about it. And I learned early on that part of managing assets is more than just the actual managing of assets. It's actually the intrinsic value you actually bring to that relationship. It's, hey, how do I work with this family and actually live life with this family? And actually, how do I help them steward their wealth in the way that really fulfills their goals of legacy? It's like a family. So it's more than just, hey, beating a benchmark and you're alpha. Actually, if you say alpha to some families, they're like, shut off. So it's more than that. It's actually bringing a relationship and actually a stewardship to the family.
How did you go about learning how to do that? Because that, to some extent, is as much an art as it is a science.
Well, that's what I wanted to do. I wanted to combine finance and mission. And so that's something that I really sought after and actually looked for. And how do I learn how to do it? Actually, I'm still learning, right? You're still learning. And then now, as with my position now, serving advisors, how I put them in the position to actually view the relationship more than just, hey, an investment relationship, but actually, hey, you're actually living life with families. And that's going to be a evolving thing that's always going to change. Because I think that's becoming more and more important and more prevalent as the business grows. The relational aspect of the advisor family relationship is more than just, hey, I'm a stockbroker. Now it's like, hey, I'm living life with the family. I'm actually the quarterback for this family's legacy and goals.
It's fascinating that you use that term because it feels like there's so many parallels to what you did on the field. My mind goes to, you were on the other side of the table when college football coaches were coming and recruiting you. They were probably sitting in your living room saying to you and your parents, hey, you should come here and here's why. Now you're almost helping families do that on the wealth management side. So I think there's some really interesting and fascinating parallels in that regard. You live that on the wealth management side as an advisor. Now you're working with advisors. How do you figure out if advisors have what it takes to be living with the families and really helping them understand what it takes to actually help them steward their wealth, gain that trust that a client should have?
I think the advisor at SageSpring is very unique to the industry. I think how we recruit and how we mentor our advisors is really client focused. I think we're the best at stewardship and legacy and actually living life with clients. And that starts with a mentoring tree that starts with, hey, a successful advisors mentoring the next generation of advisors. And I think we do that the best in the business. Our average age is 37. So we have an influx of advisors that want to be part of something that's bigger than themselves, not just commission, not just building their book. It's actually being part of something that's bigger than themselves.
What are the skill sets that you look for in advisors that fit the SageSpring culture in the right way?
Well, someone that's client focused, someone that has a calling that's bigger than just building a book of business, someone that's really curious of capital markets, but also curious on, hey, how to engage families in unique ways. And then also someone that wants to get out and meet new people and actually wants to be in their community. They're actually community leaders. We want people that want to make an impact in the community that they're blessed to be in. And so we actually want them to be leaders because actually that's what you're doing, your family. You're leading them in a way that's going to be more productive to them. And then if you're doing things like talk them off a cliff, you're talking to them about how to engage G2. You're talking to them about business succession. These are really, really heavy subjects. And so you really need someone that's willing to be curious and find the best solutions to meet the family's needs.
I think you're hitting on a really important aspect of the financial advisor business, which is how do you make sure you're serving each family and meeting them where they are? But there's another interesting question embedded in there, particularly as the wealth management space grows and evolves, which is how do you, as now the steward of the SageSpring platform and working with all these advisors who are helping these families, how do you balance that mindset and that client delivery that you just talked about with the business imperatives in the wealth management space of needing to grow a firm and growing the business side of SageSpring?
That's a good question because you need to marry the two. Like I keep telling our team that we want to go from 7 billion to 50 billion, right? 7 billion to 50 billion. And that has some communication behind the 50 billion. We just don't want to get to 50 billion just because, hey, our revenue will be higher, then our EBITDA will be greater, and then we could sell the business for more. That isn't what that's going to be true, but that isn't why we want to get to $50 billion. We want to get to $50 billion because that's the impact we want to make with the families that we work with. We know that we're affecting so much more families, affecting so much more other advisors. We're helping change the trajectory of families for the positive. That's what $50 billion means. So if we go after $50 billion and that's your goal, the rest, the business part of it would come with it. If we go after the impact being $50 billion of AUM, all the other stuff will come with it. Stewarding families through a life, helping them achieve their goals, working with families to help them be the best part of themselves. All that will come with the actual goal, the business goal of getting the $50 billion in AUM. We want advisors that get excited about that. We want advisors that buy into that. Like, oh, great. Yeah, of course we're going to get there, but I want to have impact too. I want to have impact in my community. I want to be a leader in my community, and I want to use SageSpring as a vehicle to do that. And so that kind of weeds out, because not everybody thinks that. Not everybody wants to do that. That kind of weeds out who wants to join our cause, who wants to join our movement.
How do you effectively test for that?
The key word you said there is test. And sometimes in tests, you don't get 100%. Sometimes you get something wrong. And I think someone might think they're bought in and realize that they're not. I think people might pretend like they're in because they know there is some financial value of a firm that's growing to $50 billion, but they're not really in. So I think it is a test. I think there are going to be naturally people that do fall off, just like with any ends, but it's starting off with that goal in mind that we're doing something bigger than ourselves. We want to create impact and we want to help families achieve their goals and help institutions achieve their goals bigger than just an investment portfolio.
From that perspective, do you think there is then a business construct for a wealth management business? There's all sorts of different platforms. There's firms that take minority stakes. There's platforms that own pieces of wealth management businesses and then share the services. I'm thinking that Hightowers focuses dynasties in their own ways and constructs. There's totally independent platforms. There's private banks. Is there a construct that is best? Is it totally independent owned? Is it having minority investors? Is it partner owned that creates the type of environment and culture that you just talked about?
I think all structures could be beneficial in certain situations. There's some families that prefer working with a really large bank and have all their services bundled up in that bank. I do know that a clear, distinct division of labor that allows people to focus on what they focus on really, really well, no matter what the actual underlying structure is actually really beneficial. Meaning that you have a clear, distinct division of labor of a team that focuses on the investments, a clear, distinct division of labor that focuses on the relationship, and another clear, distinct division of labor that focuses on the operations, actually putting that together. What you do is you're allowing people to really thrive in what they really thrive at best. And so that's a structure that we take here. I do think that people having ownership in the business, I think it's always beneficial because then they treat their business like it's their business because it is their business. And then also you don't have the massive amount of advisors leaving if they actually are owners in like the business. And so that's a structure that I would prefer. Other structures work great. Companies like Wells Fargo and Raymond James, they're big for a reason. And I think they're attractive to a certain type of person. You can't take that away. They're awesome firms. We just wanted to do something different.
When you say do something different, what do you mean by that? And how is SageSpring different?
Different than a really large wiring house.
Yeah, sure.
We're a true fiduciary. We're actually truly independent, where the custodian is totally different than the people offering the advice. And then that's totally different than the people manufacturing the actual products. So we could be a true fiduciary. It actually merges with our mission of creating the best type of platform or best type of fiduciary relationship with our clients. So this platform actually fits us better. And then also the opportunity to be part of something that's bigger than yourself and have ownership in it is something that you could do that with a large wiring house, a public traded company. If you have options if you get compensated in stock, but it's not the same. It doesn't feel the same. Getting stock in a public traded company is not the same as actually owning something that you're helping grow.
Do you think clients understand the gravity of what it means to have a partner-owned firm and understands what the concept of a true fiduciary mean? Or do you think clients don't necessarily think about that as much as they do other aspects of the business?
I think most clients don't think about it. I think we say it, and then a lot of firms say it. A lot of firms say that, but they are actually the ones that are custodian assets, and they're the ones that are manufacturing assets. And then they're also the same firm that's getting the same type of advice, but they're also a fiduciary. So yeah, I think that term is used very loosely too, as well. And because it's used so loosely, clients don't really know what that really means. It's our job to really break that down and actually educate the client on how viable that is. It's like your interest is our number one value. I think there is some educational aspects about that we do want to equip our advisors to then tell to their clients.
You're hitting on something which is, I think, a broader trend in general, which is, I think, you look at the trust in institutions broadly, and trust in financial services institutions has gone down over time. And younger generations, I think, also think about investing very differently. I want to touch on those 2 points as it relates to this too, because do you think that the way in which you're structured as a true fiduciary and the focus that you have on trying to engender trust from clients, will that matter more given the backdrop of the statistics and trend lines that I shared a bit earlier?
I think it definitely matters more. I think people, just like athletes, people in general are getting more sophisticated on who they choose as an investment partner. You mentioned that example of a trust and financial services kind of merged together and how that's separating. Also, CPAs and financial firms are separating too, because it's really hard to do two things really, really well. One is going to be watered down. And then also, if you're a trust company, you're not going to fire yourself. And so I think people are starting to realize that. I think there's definitely going to be value in having all of those aspects of a full financial holistic picture of working the family. I think there'll be value of having that service by separate institutions with a distinct focus, but the relationship aspect of it, there still needs to be a firm that is playing the lead to that, the lead to all those different, the CPA, the trust, the trust and estate lawyers. And this is where we want to be with our clients. You can work with the various institutions, but we want to live life with you and actually be the one that's the quarterback to those different relationships.
Yeah, I think that brings up such an interesting question, particularly around the investment side of things. So there's certainly a benefit to being completely independent because then you're truly open architecture. The challenge then becomes, how do you make sure you're able to evaluate and see the sea of investment opportunities available? How do you think about that as a platform? And I know you're thinking about it. Citywire talked about this in the interview you did with them about how you're really thinking through how you best create a platform to enable advisors to access private markets. How do you think about that challenge, but also opportunity of being able to see everything and pick from everything, but also having to do that in an efficient way?
Efficient way and then also compliant way.
Yeah.
So the trick there is, one, education with the advisors. Just because a client has $25 million doesn't mean necessarily need to be an alt. You need to know your own client and also what type of alts. Is it going to be on a semi-liquid? Is it going to be a traditional drawdown? What is that going to be for that client? Then also, in terms of the due diligence, that is extremely important. And especially when you're a firm that is growing and you don't have the personnel to really do that, who are you going to partner to actually perform a level of due diligence that meets the standard of compliance? And also the best due diligence for your clients, because you want to put them in something that you feel really great about, that's really distinct as well. And so how we did that was, going on the premise of a clear, distinct division of labor, is that we partnered with Dynasty Financial and we use them as OCIO and as our first level of due diligence. We also have an internal investment committee, but Dynasty is our first level, and they help us create bespoke solutions for our clients. But then also we work together to create some of the platform that advisors can really tap into. And there's two levels to that. One for the accredited investor that would utilize more of the semi-liquid platform where we develop a list of alternatives that advisors could actually tap into as they create their own portfolios. But then also for our larger clients, we could create something that's more distinct. And that takes time to build. But I think if a client is that large and really could withstand that liquidity, which we think would be beneficial for them in the long run, we could create something that's really distinct and actually give them access to funds that you can't really have on a platform like UBS or Wells Fargo.
How do you think about that balance of customization, but also, so I think we're at the point where access is table stakes, right? Various firms can go on the different platforms that provide the infrastructure and the investment opportunities. But then it's about customizing, and you talk about that with the larger clients. You can find ways to customize, you can leverage the partnership you have with Dynasty and others to do that. But then how do you think about this balance of customizing, but also making sure you have the ability to have scalability and efficiency around creating an alts program? Because it's time consuming and can be costly as well. So you have to balance both of those things. How do you think about those two opposing features?
As I said before, the reason why we were able to do this at scale, and we're going to continue to do this at scale, is one, the clear, distinct division of labor, and then also the ability to create relationships with strategic partners that we could leverage their scalability as we build our team internally too, as well. And that's exactly what we're doing with Dynasty. We get to leverage a firm that managed $200 billion and actually manage their bench of research and investment for professionals to actually develop a distinct investment platform as we build up our team at the same time. So as we're marching on to $50 billion in AUM, we could scale on both sides. Dynasty will be scaling and we'll be scaling too. And so we'll be able to service more and more advisors as they come on to the platform.
So I want to touch on something in that regard about being able to continue to scale with the growth of your own firm. And that will probably present itself with different ways of thinking about private markets as time goes on, the types of clients you have, the advisors you bring on, et cetera. I feel like as an industry, there's been a lot of the alternatives managers and traditional asset managers are looking to educate the wealth channel. And yes, there's a level of education that's required and helpful and important. What do the wealth managers want to know about private markets from the alternatives managers? I want to hear that side of things. You always hear the alternatives managers, their perspective on working with the wealth channel. What's the wealth channel's perspective on working with alternative asset managers?
So one thing that's really helpful is, what's the benefit of being in alternatives, especially if a family is new to alternatives? What's the benefit? So comparing a portfolio that has alternatives versus one that doesn't have alternatives, one, I think that's good education for the advisor, but it also creates an advisor to have a conversation with the client that isn't product focused. I think a lot of advisors, for the most part, on the independent side, don't want to come to the client and say, man, I have this really great secondary strategy. What do you think? Or this really great private credit. They want to say, hey, these are the sectors that we're going after. This is the benefit of having it. If that benefit is limited downside capture, is it increasing the risk adjusted return? If advisors could be equipped with the tools on how to express that to the client, that's what they're interested in, because in the back of their mind, they're saying if they have a private credit strategy, the advisor saying, how can I explain this to the client in the most efficient way possible?
From that perspective, what is the most effective way to educate the advisors about private markets?
I think you have different levels. You have an advisor that is just starting off, that doesn't know about alts himself. I think that conversation is alts 101. What is a semi-liquid? What is a evergreen fund? What is the secondary? I mean, very, very basic things. And then as an advisor progresses is, hey, how does this exposure affect your client's overall outlook in terms of returns? And then what if your client wants to express their wealth through enterprise? What if they want to invest and also have impact too? That's a conversation that advisors could also be able to have and point them in the directions of a portfolio that really meets that goal of that family. Because actually more and more families want to express themselves philanthropically, or they want to invest their values and knowledge in the way they invest in their portfolio. Yeah, you can do it in the public markets if you limit some of the things you invest in, like proxy voting, but you can really do that in the private markets. And that's an education in itself.
You're hitting on something that's so important. And I think this actually ties to a lot of what you said earlier, which is you really want to be there for the family and for their life and understand what they want to achieve and help them do that. From that perspective, tying that to what you just said, how do you think alternative asset managers can really do a good job of illuminating that what you're investing in, say I'll use infrastructure as an example, you're investing in timberland or a solar project, something of that nature. If you tie it to what the goals of the family are, that might have more of an impact than just saying, hey, this is going to return 10% on an annual basis. It's going to be inflation protection. And is that something that alternative asset managers can really take to heart when thinking about how to help advisors understand not just the how, but the why? And then those advisors can use that and really connect it to something that people can understand or see in real life.
Yeah, you need all that. But something that was good to attach to that numbers part of it, the story of a portfolio company, a story of what this investment is doing. If you attach a story to a strategy, I think that'd be extremely powerful because people remember the story a lot more than the actual strategy or the estimated IRR on something. I think that's something that's forgotten. If you're not in the business, you would. But if someone made their wealth in some other industry, that's not their skill. But every human being, though, likes story and they can relate to that. So if you can relate a story to the actual strategy impact of the fund, I think that's really, really impactful.
How can firms be most effective at storytelling?
If you have a relationship with your portfolio companies, you can weave in a story in the strategy that you're doing. You might have 25 other portfolio companies that don't have the best story, but if you could point out one or two that does resonate and also embodies your values as a firm too, that'll be awesome to share because I do want to promise you that the advisors are going to take that story and share that story with their clients, right? They're going to do that along with the estimated returns. And it doesn't have to be impact focused. Any story that you can attach on to the overall strategy, I think could be beneficial.
It could be investing in a sports fund that invests into mixed use real estate around the stadium.
Yeah, that'd be great. And a sports fund is like a story in itself. And sports are great. I mean, it generates so much revenue. It brings together people from different socioeconomic backgrounds. Sport is a story. People might think it's cool to invest with the team.
I think we're starting to see more and more of that. And certainly investing into leagues and teams is coming about. And for good reason. I think you're hitting on something so important, which is it's something tangible people can understand, feel, and touch, and feel an affinity to, which it's not all investing, to your point, but I think it's so important. I want to switch gears and ask you about the wealth management industry. What story do you think the wealth management industry is going to tell over the next 5 to 10 years? There's been so much change, new investors, firms getting bigger. What's the story that you think is going to unfold?
I think we're at the point where firms that went independent are getting so big that advisors are questioning. They left the firm to go to this independent firm. Now it's so big, it's almost like the firm that they left. So I think there's going to be some repositioning, some tree shaking in the next 24 to 48 months. I think firms that were backed by, say, PE went on a buying spree and bought a lot of practices at really high multiples. And now they're saying, well, what's next? And what is next? And so I think there's going to be a lot of shaking. And then whenever there's a lot of shaking, I think there's opportunities or dislocations for firms to gain market share.
Do you think that's going to happen because of client service or because of other things?
I think because of client service. And also I think because of advisor service. I think when you have a RIA or you have a business, your clients are advisors. If they don't feel their needs are met, if they don't feel that the platform is servicing their business, they're going to leave. And if they left a firm because it was too big, and when they had a question about a fund, they got an email or like a call service, and now they're experiencing that again, I think going to be movement. That's what I mean by the shaking of like the trees.
You're bringing up a really important point when it comes to the investment thesis around wealth management, because I think there's a lot of investors, private equity or otherwise, who look at wealth management as an incredibly sticky business and a great business to be an owner of, because from the business perspective, there's generally pretty high client retention. However, if clients leave, if wealth managers leave, will clients also leave as well?
I think the relationship, for the most part, it's with the firm, but they have the relationship with the advisor. So I think there's always a lot of risk if you don't create a platform that advisors could stay. It causes a lot of tension if advisors leave. And that's going to happen with any business. You can't make everyone happy. But depending on the platform, the relationship could be with that advisor, and you could lose a lot of business. It's up to you to create a platform that really resonates with the advisor and also with the clients.
But then scale becomes the question: is can at scale firms service advisors and ultimately end clients in a way that they did when they were smaller? I think it's a fascinating question of how we see things unfold and kind of evolve as other industries have, right, over time.
Yeah, exactly. Yeah.
I want to end by asking a final question that I always ask everyone, which is, it's a little more personal. It's, what is your favorite or most interesting private markets investment? But instead of looking backwards, I think that the market has been a certain way for a while. The market seems different today and going forward. So going forward, what is your favorite or most interesting alternative investment?
How about my most interesting alternative sector? I like private growth. I think that's something that I like betting on the entrepreneur. I like betting on the business owner because I think that's the lifeblood of our country. And so I would always allocate a portion of my funds to private growth. And that's different levels of that venture all the way to buyout. I think in terms of portfolios, I think going forward, I think the US is going to outperform the rest of developed markets. I think taking some of your allocation from your international bucket and put it into private growth is something that I think could be really, really beneficial, because I think that sector is going to outperform both US in the market and also the international markets too. So I like that market, and I think you find the best stories there too.
You mentioned stories. You created your own story as an entrepreneur. You have a coffee business as well, in addition to running SageSpring. So you understand what it's like to be on the other side of the table.
Exactly. Yeah. I mean, I think it's a really exciting place to be, and being on the other side of it, investing in that is something that's really still exciting. Not saying that the other private credit is great. It's just a different type of relationship you have with that type of investment. People are really excited about private credit, and I am too for certain big parts of the portfolio, but I really like private growth.
Equity and debt are very different things. Howard Marks did a memo from Oak Tree on ruminating on asset allocation, where he talked about that exact thing. Equity and debt are very different things, and you have a different relationship with the company as a result, for sure, right? One is a fixed contract to get a certain return. The other is participating in the upside. But I think you highlighted this and made it really so important to see in the context of this conversation, is that particularly in the wealth management space, being an owner is so important. Being a partner is so important.
Exactly. Yeah. Being a partner, being an owner on both sides, actually in your day job, but then also investing because those private equity funds are owners in that business, and they have a vested interest in that business to do well. Right. And investing in that is great. I think that's what makes our country go round.
I think that's such a exciting and fantastic way to end this podcast, because it shows the optimism of building businesses and continuing to build businesses and helping people build businesses. And I think just such a fascinating conversation, covered so many things. You've protected quarterbacks, you're protecting people's financial futures, and you're building a business. So congrats on everything you've done. And thanks so much for sharing all the thoughts and wisdom that you've had from both careers.
Awesome. Hey, Michael, thank you so much for having me. This was a blast. Reach out anytime. I'll do it again.
Pleasure to have you on, Winston. Thanks so much.
Thanks.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going